Hello and welcome back to All Things Money. I'm David Blain, your host for the show. We thank you for joining us for this third segment of today's show. We've been talking a little bit about the impact of the presidential election on the markets, the sell-off that has occurred the past week or so, and the reasons for that and what implications, if any, it means for your portfolio. You know, should you make some changes? If you missed that, head on over to the web, www.dlblain.com. And we post archive copies of the show there. You can catch up. Right now, we're talking about should you make any changes to your portfolio based on the economic news out there. And in summary, kind of give the bottom line up front. The bottom line is I think it's a very poor idea to make large changes to your portfolio based on economic news. The evidence is overwhelming that the markets are not predictable, certainly not in the short term, that the market exhibits a random pattern of behavior, especially in the short term, and trying to use some sort of economic news to predict where the market is going to be is just it is not proven successful by anyone. People always point to Warren Buffett and sort of these outliers, and I've said many times before not to take away anything from Warren Buffett, but if you take billions of people that have been investing over the time period that he has been investing, just pure statistically, you would expect a Warren Buffett to appear, and you cannot necessarily attribute that to skill. Anyway, we're kind of getting off topic. I want to get back to how this impacts your portfolio. So at any point in time, there's always a number of positive impacts on the market and negative impacts, and they kind of cancel each other out, and they're all incorporated into the market. You have to remember that whenever somebody sells Apple stock, Apple is down about 25% from its peak. Every person that's selling Apple, somebody's buying it. The markets are really, truly a zero-sum game. Unlike a country's economy where GDP growth, can be affected and everyone can benefit, the actual buying and selling in a stock market, which is separate from an economy, is truly a zero-sum game. That whenever someone sells something, another investor had to buy it. When someone is buying something, that means someone else is selling. And so it's these imbalances. When you have more buyers than sellers, the price tends to go up. When you have more sellers than buyers, the price tends to go down. Well, I shouldn't use that. When the selling demand is greater than the buying demand, but the reality is there are the same number of sellers as buyers. There has to be. For every seller, there has to be a buyer. It's just that at what price are they willing to buy, and that's what causes the price to go down. So anyway, the point is that you sitting at home or some guru sitting in Wall Street to think that they, at all times, over a number of years, are smarter than all the aggregate participants, it just has not proven out. That the market expectations are usually as accurate, if not more accurate, than any one particular guru. Now, as I said, there are times where the markets can be riskier. Interest rates are very low now, so there's some element of risk involved in the fixed income market. But to sit there and say, well, interest rates are definitely going up next year or the next 2 years, that's a very bad game to get into. You're probably going to lose. That we think, right now, for example, the impending fiscal cliff, the continued weakness in Europe, I mean, those are two huge things dragging the market down. On the flip side, housing is recovering, and housing can be a great stimulus to the economy. Number two, there are still a lot of people without jobs, and I was talking with somebody before this, the old saying, if you were in a recession when the unemployment rate is high, and it's a depression when you lose your job. And I don't want to minimize it, but the fact is that unemployment, there are some jobs, not nearly enough, but my point is it's better than the depths of the 2008 market. It's not anywhere near where we need it to be, and it's certainly not robust growth, but it's not as bad as it was. And so there are certain positive things. Corporations, highest profitability margins in history, really. So there's some positive things. And we think the best way to capture this sort of growth in the economy over time is to stay invested in some sort of portfolio that's designed around your tolerance for risk, the goals that you have, and to stay within that target and adjust it modestly, around the edges as things have changed or as one asset class goes up in value or another declines, is to rebalance to that risk. One of the things that even when people feel overwhelmed and they feel like they just have to throw in the towel and move to cash, the thing that gets people, and there are a lot of people that are very good at this. I shouldn't say very good, but there are a lot of people that have made the correct decision. That, in 2008, they felt like the risk was too high and they moved out of equities into cash. In fact, we did that with a lot of people simply because their portfolio didn't match their risk tolerance, that we felt like their risk tolerance was much lower maybe than it had been previously. But the point is, it's that second decision of, okay, when do you get in, which is where people lose out the most. There are a lot of warning signs in the economy, and people do successfully avoid bear markets, but on the other side, it's very difficult to choose the time period to get back in the markets. Today, cash provides no protection against inflation, and the rates you just don't make anything. Back in the 2000s or late 90s and early 2000s, money markets were paying 4 or 5%, and so at least you could pick up a little bit of yield while you were in cash. And so as a general rule, we think that people need to stay invested as markets drop. Now, if your situation changes or your risk tolerance changes or something in advance, that's when you do the planning and design your portfolio. You could say, well, I'm now 65 and I'm retired and I just don't feel like taking as much risk as I used to. That's fine. Change your investment strategy, change your investment mix, but don't say, well, the fiscal cliff is definitely going to happen and Europe is going to implode and so we're going to move all to cash. No one has proven the ability to be able to successfully time those type of moves on a wholesale basis. Now, there's nothing wrong with, taking 10% or 15, 20% if it makes you feel better, but to go from on, off, it just does not generally work out well. So that would be our advice, is don't make a lot of rash decision based on what's going on in the economy today. Well, that's all the time we have for today's show. I hope you've enjoyed it and that you come back and listen or watch again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.